Hey, Jennifer, Mike Baltazar here. Hope you have a fantastic day. And I just wanted to share with you an example of what we talked about earlier with regards to uh, assuming a VA loan in the process of purchasing a home. So, just want to give you an example here of a property that just came on the market. Now, I know you're not looking in Peoria, but I think this illustrates what the possibilities could look like. So in this case, they are selling a four-bedroom, three-bath home. Great picture here on the outside, and they're asking $565,000 for it. Now I know that that number is outside of your price range, but I think it's outside of our price range primarily because of what mortgage rates are today. So right now, mortgage rates are in the sixes, right? Whereas on this example, you could assume their VA loan, and I'll talk about what balance is remaining here in a moment. You can assume their VA loan at 4.12%, which is a lot lower than what's available right now. Now, how it works out with dollars and cents is that you would be assuming their remaining balance, which is $532,000, and then their principal and interest payment is $29,1156. Now, I want to go over to an example. Actually, it's some behind the scenes numbers on this here. So again, here's the remaining balance, here's the interest rate, and then again, here's the principal and interest payment for that loan. The really cool part is this is how many payments are remaining. So that means there's basically, about 24 years left on their present loan. So basically, they're already 6 years into this mortgage, and you get to pick up where they are leaving off. And as you know, there's a lot of interest on the front end of a 30-year mortgage. So they're already 6 years past the hard part, the really hard part, I should say, and it allows you to jump into it, which is really nice. Now, let's just say, for example, that you were borrowing this same $532,000 at today's rates. I want to show you what this payment would look like for the same 24 years remaining. So again, here we have that balance, the same payments remaining. Rates are lower than this right now, but let's just say, it's 6.99. We were in the sevens not too long ago, right? But here's the principal and interest payment on that scenario, which obviously puts us way outside of our comfort zone because you still have to add taxes and insurance to it. But it's almost $1,000 higher than where we're at on that assumed loan. And even if, and I'm just going to run some numbers here for real quick, even if we wrote this loan for 360 months, let's say, the principal and interest payment is still going to be over $3,500, which is about $630 more than this mortgage that's already 6 years paid into it. So you can kind of see where the economics are grossly in favor of assuming a loan if it's possible and if it's a good match. We don't want to settle on the home if it's not the best fit for you, but I just wanted to show you where you could get a lot of value for the opportunity. Now, the estimated cash to close is $32,564, which is the difference between their loan balance and then also the listing price. So that's something to keep in mind as an opportunity for you. Another thing to keep in mind is that there's no appraisal needed. Obviously, the rate's below market value or below market interest rate, I should say, and then the closing costs are drastically reduced. So I just wanted to show you how it would look like if we were able to find the perfect home in your area. And again, where the estimated cash to close isn't too much. I know I shared some really good interest rates for homes in the area that you're looking, but the estimated cash to close was a lot of times in excess of $100,000. So I just wanted to again show you an example of what it would look like. I will keep looking for you. And if you have any questions, just let me know. Have a great day.